All right, let's dive into the story of Ainos Inc. today. And it really is a story, a tale of two very different business engines. See, this company is running on a dual platform strategy, and these platforms are operating on two completely different timelines. Understanding that duality, well, that's the key to understanding the whole picture.
Okay, but before we get into the nuts and bolts, we have to cover the essentials. This research communication is not investment advice and does not constitute an offer, solicitation, or invitation to transact. Full disclosures and limitations are included in the report. And just so we're all on the same page, what we're doing here is breaking down a non-rated equity research report on Ainos. This report comes from the analysis firm VASRO, and our job is to unpack their findings for you.
So here's how we're going to tackle this. First, we'll look at the big picture, that dual platform strategy. Then we'll zoom in on each engine one by one. First Ainos, then VELDONA. After that, we'll piece it all together into the main investment story and its risks. And we'll wrap up by looking at what's coming down the pike, the catalysts, and the big questions you should be asking. So let's get right into that core framework. The best way to think about Ainos, at least according to the VASRO report, is to picture a company with two separate engines, both running but on totally different tracks and at different speeds.
And this table really lays it all out for us. On one hand, you've got Ainos. This is all about turning smells into digital data. The money's already coming in here through hardware and software subscriptions, and we have real proof points, like a big order from AS Technology. For this engine, it's all about sales and execution. But then, on the other hand, you have VELDONA. This is your classic biotech play, a longer-term bet with huge potential. Its value isn't about sales today, it's about getting through clinical trials and landing big pharma partnerships down the road. So you see, two totally different risk-reward profiles living under one roof. Okay, so let's focus in on that first engine Ainos. The report really frames this as the company's #1 priority right now. This is the engine that's supposed to be driving value in the near term. So, what does it actually do? Well, in simple terms, the Ainos platform takes smells, or more specifically, what are called volatile organic compounds, and it translates them into a digital signature, something they call a smell ID. Right now, they're really focused on industrial uses, for smart factories and that kind of thing. But the bigger vision is to eventually move into areas like healthcare and safety. Now, the business model here is absolutely crucial. Ainos isn't just selling a gadget. They're selling what they call smell tech as a service. What does that mean? It means a customer gets the physical nose, but they also have to pay a recurring subscription for all the important stuff, the data analysis, the cloud connection. For anyone looking at the business, that's a big deal. It means they're building a scalable, predictable revenue stream.
And look, this isn't just an idea on a PowerPoint slide. The VASRO report points to some real, tangible progress. The big one is a $2.1 million 3-year subscription deal with the semiconductor giant ASE Technology. That's huge. Plus, there's a really interesting partnership with Merle Automation to actually put these noses on mobile robots for inspection work. It all lines up with what the report says was a very deliberate strategic shift planned for 2025, moving away from just R&D and getting this technology deployed in the real world.
All right, now let's switch gears and talk about the second engine, VELDONA. This is a totally different part of the story. Think of this as the long-term biotech potential. The report uses the word optionality, which is just a fancy way of saying it's a high-risk, high-reward asset. It's not making any money right now, but it has the potential to create a ton of value way down the road.
And when you put them side by side, the contrast is just stark, right? Ainos is all about what's happening now, in the next year or two. Commercial execution, subscription sales. VELDONA, on the other hand, is a 3+ year story. Its value isn't driven by a sales team, it's driven by scientists and regulators. It's all about hitting those clinical trial milestones and eventually landing a big licensing deal. So what is VELDONA exactly? Well, the tech is a low-dose oral version of something called interferon alpha, which helps regulate the immune system. They're initially targeting 2 conditions, primary Sjogren's syndrome and HIV-related oral warts. Now, here's a really crucial point. For that oral warts program, Ainos already has an orphan drug designation from the US FDA. That's a big advantage that can make development smoother and cheaper. The strategy right now is to run the first trials in Taiwan to get data that can then be used in broader regulatory talks later on.
Okay, so we've got the near-term tech engine and the long-term biotech engine. Now let's try to put it all together. What's the core investment story here, and what are the major risks? Let's get into the balanced view presented in the VASRO report.
So the story really has 2 sides. The bull case, the upside, is pretty clear.
If Ainos can really scale up that AI knows recurring revenue and build a powerful data advantage, that's a game changer. And, of course, any positive news from the VELDONA trials would add a whole other layer of value. But the risks are just as real. The company is leaning heavily on partners like ASOA and Merle to get its tech adopted. VELDONA faces the same make-or-break risks as any drug in development. And then there's the big one, funding. And to put a real number on that funding risk, the report points out that at the end of the third quarter of 2025, Ainos had a cash balance of $0.85 million. Now, you don't have to be a CFO to see that running two ambitious platforms like these is going to require more capital. Securing that funding is going to be critical.
So with that whole picture in mind, what should we actually be watching for? This last section is all about the road ahead, the key events, and the big open questions.
Over the next, say, 6 to 18 months, the report says it really comes down to three things. First, AI knows execution. Are they converting pilot programs into full-blown contracts? Are customers renewing their subscriptions? Second, VELDONA progress. How fast are they enrolling patients in those Taiwan trials? Are we seeing any early data? And third, underpinning everything is financing. How is the company raising money to fuel all this, and are they doing it without hurting existing shareholders too much?
And you know, when you boil it all down, it really comes back to this one single powerful question. Can the money and the momentum from the Ainos platform, the near-term tech engine, be enough to build a bridge to the company's longer-term high-stakes biotech dream with VELDONA? That really is the central challenge and the central opportunity for Ainos right now.
Now, we've hit the major takeaways from the VASRO analysis today. But remember, this is a summary. For the full, detailed breakdown, including all the important disclosures and limitations, we absolutely encourage you to go read the original equity research report yourself. Thanks for tuning in.